I'm pleased to report that Indi delivered another record quarter of results in Q3, driven by increasing demand for our highly innovative auto tech solutions, coupled with absolutely tenacious operational execution. We were once again able to substantially outperform the automotive industry and navigate the challenging supply chain environment owing to our breakthrough product portfolio and differentiated core IP, as well as leading customer and supplier partnerships, supported by a world-class team of over 600 Indi employees worldwide. Specifically, during the third quarter, we significantly outpaced our addressable markets and grew revenue 147% year over year and 17% sequentially to just over $30 million, while expanding gross margin beyond the 50% mark for the first time. As we'll outline, our ADAS, user experience, and electric vehicle solutions are gaining design win traction across leading Tier 1s and global automotive OEMs. In fact, I'm delighted to announce that our strategic backlog has reached the sum of $4.3 billion as of today, a more than doubling from the $2 billion we outlined at the time of our IPO launch less than 24 months ago. This significant growth reflects large-scale program wins across our product portfolio, and especially within radar, vision, advanced lighting, and wireless charging applications with both new and existing customers. Accumulating this level of strategic backlog in such a short amount of time validates our decision to IPO sooner. Historically, customer feedback indicated a stronger balance sheet was key to securing substantial programs. Post-IPO, we have quickly moved up in weight class, and not only are we on numerous approved vendor lists, but we are increasingly offered some of the largest opportunities within auto tech. Given the over-consolidation within automotive semiconductors over the past decade and the extremely high barriers to entry, I fully expect us to continue to outpace the broader automotive market and win a disproportionate share of new programs over the coming years. Keep in mind, when we founded Indi in 2007, there were roughly 30 semiconductor companies who had sizable auto IC businesses. Yet by the time that we went public, there were only a handful remaining due to aggressive merger and acquisition activity in the interim, as companies and VCs alike turned their attention away from automotive semiconductors in search of short-term investment cycles. Just as the competitive landscape was dramatically thinning out, massive demand was building for next-generation technologies, ranging from highly integrated safety systems to in-cabin solutions, as well as more power efficiency following the advent of electric vehicles. Quite simply, there were not enough qualified semiconductor suppliers supporting the global automotive market. Over the past decade, legacy incumbents have been focused on optimizing their operating margins to maximize cash return to shareholders at the expense of R&D investment. As a result, product roadmaps have suffered, and when capacity became tight during COVID, steep product price increases passed along to Tier 1s and OEMs further inflamed the channel, which still led to empty car showrooms around the world. These dynamics have contributed to Indi's ability to effectively 5x our revenue run rate over the past 24 months, and more importantly, add large absolute dollars to our strategic backlog, setting the stage for accelerating top-line growth over the coming years. Reaching this point has of course not been easy, and there were no shortcuts. We're an overnight success, just 15 years in the making. Through the lean years, challenges included having a critical mass of design talent, demonstrating product reliability, possessing a strong financial foundation, and adhering to all requisite automotive quality standards. With nearly 200 million unit shipments now behind us, and Indi content within marquee automotive brands around the world, including Audi, BMW, BYD, Ford, General Motors, Hyundai, NIO, Nissan, Porsche, Stellantis, and Volkswagen, to name a few, those prior headwinds have now turned into tailwinds for us. As such, our growth engine and opportunity funnel is just getting started, in pursuit of the uncrashable car and a revolutionary in-cabin experience. To that end, Indi is uniquely investing in a range of automotive sensor modalities deployed in new and emerging vehicles, including ultrasonic sensors, visible spectrum and infrared cameras, light detection and ranging, or LiDAR, as well as short-range and long-range radar. We are technology agnostic and believe that each of these sensors will play a critical role within the next generation of vehicles. As no single sensing modality can meet the requirements of all autonomous and safety features, the industry is moving towards sensor fusion, the ability to bring together and process inputs from multiple sensors including cameras, LiDARs, and radars for vehicles with higher levels of automation. Indi is at the forefront of this edge sensing sea change and offering various solutions to address different sensor modalities. In fact, today, we uniquely offer a range of sensing solutions including our Sonosense and EchoSense ultrasound family, featuring built-in digital signal processing. By quick background, ultrasound operates above the human hearing range at 40 kHz and is commonly deployed to provide practical, low spatial resolution and short-range sensing use cases up to a few meters, such as park assist. During the quarter, we ramped our ultrasound portfolio at leading Tier 1s and in support of multiple car OEMs. At the other end of the performance spectrum, vision sensors operate in the visible light or in infrared and offer the highest spatial resolution. When this superior resolution is combined with color, contrast, and character recognition capabilities for road sign reading, for example, vision-based sensing provides a level of scene interpretation, object classification, and driver visualization that other sensing modalities simply cannot match. Vision use cases include surround view, driver and occupant monitoring, digital mirrors, forward-facing cameras, autonomous emergency braking, and lane centering. I'm pleased to report that during the quarter, our Vision business unit captured their first design win, setting the stage for global proliferation of Indi vision solutions for years to come. Turning to LiDAR, which uses a laser to illuminate the scene, and incidentally is not a material contributor to our strategic backlog yet. Our solutions are clearly resonating within our partnership channels. During the quarter, we were awarded LiDAR Solution of the Year by Autotech Breakthrough, plus LiDAR Development of the Year by AutoSense. We are working closely with half a dozen partners on our Surya SoC development program's design phase as we speak, with plans to convert pipeline opportunities into contracts and ultimately substantial revenue. Surya is a truly unrivaled LiDAR solution, comprising Indi's innovative high-speed analog, mixed signal, DSP and software, combined with Teraxion's best-in-class laser and sensing technologies. Through our unparalleled semiconductor software and optical integration, we believe Indi can uniquely democratize three-dimensional imaging, which is ideal for creating extremely accurate depictions of the vehicle surroundings, pivotal to enabling the high-level autonomous driving use cases of tomorrow. Lastly, and by no means least, radar represents Indi's single largest ADAS investment area currently and fastest growth avenue. Radars operate in the radio frequency at around 80 GHz and can detect objects and relative speeds from less than a meter up to 300 meters in darkness or occluded situations, making it an extremely critical sensor. Today, radar is widely deployed for automatic emergency braking, adaptive cruise control, lane change assist, and blind spot detection application. In the near future, it will also enable the high-volume cross-traffic detection application. Through our acquisitions of Analog Devices Radar Division, as well as onsemi's radar team, we have accelerated our product development, bringing together leading enabling technologies, over 250 man-years of cumulative development, 205 related patents and applications, as well as world-class mixed-signal SoC capabilities, effectively rounding out our sensor modality portfolio. In fact, earlier this year, we captured our single largest design win and entered into a strategic supply agreement with a leading Tier 1, which contributed to the majority of the incremental increase in our strategic backlog. Shifting gears to our user experience portfolio, you're likely noticing how automotive OEMs are increasingly advertising convenience, electrification, range, and a modern in-cabin experience, and are talking far less about torque and horsepower. And by looking at a vehicle beyond being a functional tool for travel, we see the emergence of a radically different cockpit environment, where passengers engage in communication, entertainment, and information sharing, in effect, a temporary home, and for many, a workplace. In this view, we see the powerful role intelligent interior electronics can play in delivering the best possible user experience throughout the cabin. Lighting has always been a fundamental aspect for vehicle design. However, in modern automobiles, in-cabin lighting goes far beyond a functional or safety necessity and is critical for enhancing the user experience of vehicle occupants and developing a positive association with the automotive brand. In fact, Audi has publicly stated that lighting visualizes the brand's core values: progressiveness, sportiness, and sophistication. The ability to provide automotive designers with more options and form factors for lighting placement throughout the vehicle has opened the door for advanced LED technologies and smart lighting systems. These advancements benefit not only interior cabin lighting and instrument illumination, but external vehicle headlights and taillights. At the same time, seamless integration of mobile devices within the automotive environment is increasingly the way OEMs can differentiate their cars. As a result, providing high-performance mixed-signal interfaces to bridge these two worlds is now a key element of intelligent cabin design, which means implementing systems such as Apple CarPlay and Android Auto that allow occupants to safely use their mobile devices to make calls, send and receive messages, and enjoy their favorite music seamlessly. Also, the provision of the USB-based power delivery infrastructure supports the often simultaneous in-cabin charging for mobile phones, plus higher power devices such as tablets and notebooks. As a testament to our progress in advanced lighting I'm particularly pleased to report that during the quarter, we were able to secure initial production orders from our newest generation lighting products from two of the big three U.S. automotive OEMs. Finally, in the EV area, we were able to expand our design win footprint at multiple electric vehicle OEMs. We are seeing an accelerating shift to electrification amid longer-term secular tailwinds. According to Cox Automotive, EV sales grew 67% in the third quarter of 2022, while overall U.S. auto sales were down around 1% for the same period. While penetration of EVs has increased considerably to 6% of U.S. new vehicle sales, up nearly 3 times in the last 2 years, the U.S. has a long road ahead to reach a similar mix of EV sales as Europe or China, let alone the Biden administration's target of 50% of new vehicle sales by 2030. Indi is well positioned to benefit from the electrification megatrend and capture significant share due to our strong relationships with an increasing number of leading EV OEMs. Further, our broader Autotech portfolio tends to gain a substantially higher attach rate to newly designed electric vehicles, given our degree of innovation and power efficiency, critical to maximizing vehicle range. With that, I'll now turn the call over to Tom for a discussion of our results and outlook.
Indi delivered a strong third quarter once again on plan and producing record results. In fact, Q3 represents our 6th consecutive quarter of beating or at least meeting our guidance post Indi's IPO last summer. Revenue for the period was up 147% year over year and 17% sequentially to $30 million. Gross profit was $15.1 million, translating into a 50.4% gross margin, up 740 basis points year over year and 180 basis points sequentially and above our 50% guidance. To put this performance in better context, when we announced our plans to IPO in Q4 2020, Indi was at just $6.7 million in quarterly revenue with a 35.4% gross margin. Since then, and despite global supply chain constraints, we've successfully scaled our business nearly 5-fold and increased our gross margin by 1,500 basis points in less than 24 months. Turning back to Q3 results, operating expenses were $30.9 million, slightly better than our guidance for $31 million. In particular, R&D investments were $24.2 million in support of accelerated product development, while SG&A of $6.7 million reflects continued investments to further extend our sales reach. As a result, our Q3 operating loss was $15.8 million. Interest and other income yielded $500,000 and taxes were negligible. In turn, our net loss was $15.3 million with a net loss per share of 10 cents on a base of 150.7 million shares, 1 cent better than our guidance. Turning to the balance sheet, we exited the period with $150.8 million of cash and limited debt. During the quarter, we invested $9.9 million in working capital, including one-time inventory prepayments and IP licenses. Capital expenditures were $2.7 million in support of expanded lab equipment and global IT infrastructure. Finally, and as an offset, we raised $12 million through the sale of 1.5 million shares under our ATM program. Looking forward, based on the depth of our new product pipeline, we plan to maintain outsized top-line growth while further expanding our gross margin over the planning horizon. Specifically, for the fourth quarter of 2022, we anticipate sales growth to an approximately $132 million annualized revenue run rate with gross margin expansion into the 51% range. We are planning nominal increases in operating expenses with $25 million in R&D for additional mask sets and $7 million of SG&A for incremental marketing investments, but further reductions, again, on a percent of sales basis. Below the line, we anticipate a pickup of $750,000 of net interest income and no taxes. Assuming 152 million shares outstanding, we expect a net loss of 9 cents per share, once again a penny better than consensus estimates. Given our strong order visibility, demonstrated scalability, and planned operating expense leverage, we are on track to reach profitability in the second half of next year, with narrowing losses from here, representing key next steps towards realizing our 60% gross and 30% operating margin target model. With that, I'll turn the call back to Donald for his closing comments.
To summarize, Q3 marked another quarter of record results for Indi, and we couldn't be more excited for the opportunities ahead, particularly given the $4.3 billion of strategic backlog we've achieved. Our comprehensive and differentiated portfolio of ADAS, user experience, and electric vehicle solutions are gaining design win traction, which is beginning to translate into substantial revenue growth as new programs and customers ramp around the world. Accordingly, Indi has never been better positioned to capitalize on our $27 billion annual serviceable market opportunity, sustainably outpace industry peers, and ultimately to create extraordinary shareholder value. We look forward to updating you along the way. That concludes our prepared remarks. Let's open the call for questions.
And our first question is from the line of Suji DeSilva with Roth Capital. Please go ahead.
Yeah, so some specific questions. A lot to talk about, obviously. The Vision Q wins in computer vision, the first one you've gotten. Can you talk about the progress from when you announced that, Donald, a few quarters ago to this first win? What kind of happened in the interim? And more importantly, competitively, there are guys out there like Mobileye who are very well positioned, also Umbrella. Curious how you see this playing out going forward.
Well, that's a good question, Suji. I mean, really, since we announced the presence of the group, I guess 3 or 4 quarters ago, maybe more now, I forget. It's really been heads down and executing on just a really phenomenal product definition that we came up with. The resonance in the market has been phenomenal for this, and this is the first commitment for this product that we expect will be the first of many. I mean, as regards the names that you mentioned, we don't really see ourselves competing head to head with these guys, and in most cases we're more or less adjacent to them. We view ourselves as providers of edge interfaces very close to the metal of the sensors that provide a layer of abstraction. Perhaps the guys who are maybe focusing a little more on the central compute.
Okay, helpful to draw that distinction there. And also another area to ask about, the lighting area, very impressive. 2 of the 3 big auto guys. I'm curious if those are competitive wins versus what those car makers were using in the past, or whether these are kind of new platforms that you're kind of parachuting into.
I mean, largely when we deploy new programs, we're at the point where there's a new piece of technology being deployed. We always view that when there's an inflection point in the market, it creates the greatest opportunity for us to deploy a new technology. So largely in those cases, it's been fairly new. I mean, there are competitors in the market, of course. If there weren't, then they wouldn't be worth competing ourselves. So of course we do take share away from some people in some cases, but I mean, largely speaking, usually it's when there's new deployment of technologies, and these kind of programs deploy perhaps a touch more quickly than some of the other things that we work on, and they still have a very nice dollar content per car.
And our next question is from the line of Ross Seymour with Deutsche Bank. Please go ahead.
Hi guys, thanks for letting me ask a question. One is going to be near term and then one longer term. For the first one, the nearer term, you guys had talked about some of the supply shortages. It didn't seem to slow you down, but it definitely was gumming up the works in an aggregate sense. So any change in kind of the supply-demand environment in the very near term?
Well, with consumer demand falling, we have seen some significant easing in certain aspects of the supply chain. Particularly package and test now is fairly relaxed compared to what it was 12 to 18 months ago. Wafer supply in certain nodes is significantly alleviated, but in some of the more trailing nodes where they're particularly focused on mixed signal, they are still somewhat tight. And the demand for those kind of products is still super high. I mean, we see that being in very strong demand as far as the eye can see, really, through 23 and beyond, as far as we're concerned. So there'll still be something to manage through for us, but we spent a lot of 2022 tightening our contracts, making forward-looking commitments to particularly our wafer suppliers, and then also asking our customers to make that pass-through commitment to us to take the product. So it does give us a very nice sort of short and medium-term visibility of where we're going with the revenue.
Thanks for that color. And I guess as my follow-up, a little bit more longer-term question, the strategic backlog is impressive, but I want to just dive a little bit into 2 aspects of that. The composition of it, how that's changing. I know you talked about radar being the biggest portion of the incremental increase year over year. Any more color you can give on that? And then similarly, the margin profile of that backlog and how that evolves versus either your current gross margin or your targets of 60% longer term.
Yeah, I mean, obviously, I mean, we won't split it out in definitive terms, and it's been strong across our whole product portfolio. The ADAS space, of course, is becoming, as compared to perhaps 2 years ago, a larger percentage of the whole, and the radar win was a very significant part of that, as indeed was the first vision win. To the second aspect of it, typically these products do, in that space, carry higher gross margins, so we view that as tailwinds towards our target of getting to 60% gross.
And our next question is from the line of Anthony Stoss with Craig-Hallum. Please go ahead.
Can you explain, is there any major hurdles that are left between now and, I think you had said in the past, late 2024 launch? Also, how quickly could it ramp? I know into this radar maker, it's probably into, half a dozen or more auto OEMs. Any additional information you can give on hurdles and timing and how quickly it'll ramp would be helpful.
Well, from a technology perspective, it's an area that we're very strong in, have been historically as a group and a team. It's not rocket science, but it is a heavy lift from a development perspective, and we have a phenomenal team and a very large team working on this to make sure that we meet our commitments, hit our milestones, and get to production with this. We're not going to release specifics about our programs, but suffice it to say we're pretty happy with the way it's going right now. In terms of speed of ramp, there is let's say a very strong motivation to get this into production as quickly as possible through the tier one into many OEMs, and I do expect that conversion process will be extremely quick.
Got it. And Donald, just to follow up on your prepared remarks, you talked about cross-traffic perception in your radar solution. Can you give a little bit more detail on that? And then would that be part of this radar win?
Well, yes. Cross-traffic detection, you mean, is basically somebody cutting across your bows, let's say at an intersection or whatever. And the way that they make that happen is by having a radar on each of the front corners of the car in order to make that determination. So basically what it does is it means that it adds 2 more radars per car, which is just music to my ears. It's more radars means more chips means more money. So that's how that's going to play out for us. And the reason why, not only that just because it's nice and makes people feel safe, but it's going to be mandated by the regulatory agencies.
Gotcha. And then 2 last quickies. If you could give a little bit more detail on the breakout of the $4.3 billion backlog, what portion is power, lighting, et cetera, and then also the fact that you're not including any LiDAR in that $4.3 billion backlog, is that an indication that you think LiDAR is still further out for the industry or a lack of role for you guys to play? I'm just curious your thoughts there.
In the first one, we're not going to give you specific numbers or dollars or percentages of what the backlog breaks out to be, but it is all of our product portfolio are fairly well represented in there. Of course, we've called out the radar win as being very significant, and we've allowed you a little bit of triangulation there with a few percentages to try and figure that out for yourselves how big that is. In terms of LiDAR, we do see it as being a little later in the market. We do see it as an incredibly relevant technology. So for us, we absolutely believe that we'll participate strongly in that. And in fact, we expect to be leading that in technology when the time comes. But for us, we are also very focused on high volume, high revenue models where we can get return in a reasonable amount of time. And LiDAR, although we're continuing to invest in it, we do believe we'll be a little further out, but we'll be there.
One thing, Tony, I'd add on the backlog is it's actually remarkably diverse. So it's cutting across a dozen product areas and is underpinned by 20 tier ones and automotive OEMs.
And our next question is from the line of Craig Ellis with B. Riley Securities. Please go ahead.
Yeah, thanks for taking the question. I'll echo the congratulations on the record gross margins and the backlog performance. Nice to see those numbers.
Thank you,
Donald. Yeah, you're welcome. I wanted to start off just by following up on LiDAR because I think 3 months ago you indicated that there were 4 customers with which you're engaged, and now I think you said a half dozen. So the number's clearly gone up. Can you talk a little bit about what's changed with customer engagements and what you're seeing as you work with the 6 different partners?
It's we've added incremental engagements to what we'd announced before. We don't see any behavior change in that period. Certainly, there's a lot of drive to bring the technology to market. There are still some hurdles to be crossed, not necessarily from our side, but for the whole market. And so, really, I wouldn't call out anything as having been significantly changed. But over the course of 23, 24, there'll be some small volume programs that launch, but wouldn't move the needle, for example, for our revenue if we were participating in that already with content. You just wouldn't even see it. It'd be a rounding error. And as I mentioned in the last question there, we're very focused on large volume, large revenue, which with LiDAR will come. It'll just take a little longer.
Yeah, and nice to see what's going on with radar. The second question is regarding the comment that I think the team is now 600 employees across the world in your different design centers of excellence, and they're in the home office. So the question is this: as you look at the opportunities in front of you and the current employee base, Donald, where do you think you need to invest, and how are you thinking about M&A, because it has been a very successful part of building out your technology capability, and how are you thinking about that now?
Yeah, I mean, it has. I mean, we've grown a lot, of course, in the last few years. We are entering into somewhat of a digestion phase there as we organize and incrementally recruit. In terms of M&A activity, it is still, of course, a core part of our DNA. I think we're pretty good at it, and I'm sure we'll make success of that in the near future or in the long-term future. But for us, the barrier to entry into having an acquisition is very high. I mean, we have very high standards. It has to be something that's going to accelerate our progress to our goals, or to provide us with a significant augmentation to our IP portfolio, such that we can make better products and deploy them into our customers. So, we look at a lot of deals, we pass on most, and, as such, it'll be part of our long-term strategy, but kind of no news right now.
That's very helpful. And then lastly, Tom, not to leave you out, like the strong reiteration of the flip to profitability in the second half of next year, if you were to list out the 3 or 4 things that give you confidence in that transition, what would they be? Thank you, guys.
Yeah. Oh, sure. Yeah, well, clearly the strategic backlog being fully booked basically into next year gets us there. Continued gross margin expansion into the mid-50% range, and then OpEx is really just nominal growth from where we are now.
Thanks, everybody, for your time. Look forward to seeing you at the upcoming investor conferences and at the next call. Thanks a lot.